Sasol reported a decline of 34% in its half-year profit, mainly due to weaker oil and petrochemical prices as well as higher costs. The company declared an interim dividend of 2 Rand per share, down from 7 Rand previously. Shares in Sasol traded around 6% weaker in early trade. For more on the numbers, we're joined by Sasol CEO Fleetwood Grobler. Fleetwood, thank you so much for your time. In an environment, rather, where you find yourself where there's a lot of volatility, there's uncertain regulatory aspects playing around, not forgetting the electricity and logistics problems. Take me through the progress you've made so far despite these challenges.
Yes, thank you for that context. I think when I look at the reporting period, we have indicated that most areas we have increased our volumes year on year. So the areas that we control or we've got an impact on is to make sure that our volumes remain in the potential that we can produce it into. And the other part of it is the control of our costs and capital program. So those are the two areas in terms of cost and then on volume. So if I take you through the areas just to get you a flavor of how it played out over the past 6 months, when I look at year on year, our mining export volumes of coal has increased by 16%, but we saw a headwind on pricing of around 59%. If I look at our gas business, we had a 10% increase in volume, but as the input cost is dollar-based and the exchange rate worsened, our recovery in terms of the gas pricing is in South African rands, and that stayed flat. So there was no recovery of these costs out of the market. On our fuel segment, we've increased by 3% on a volume, or 8% on a volume basis, but on the cost side, we've seen a rise of 15% more cost. Chemical Africa, again, 3% increase in volume, but a headwind of 21% on cost. USA, 12% on volume increase, but a headwind on 28% on cost. On pricing rather of products, and Eurasia the same, 28%, similar to the US, of a 23% headwind on product pricing. So what we focus on right now is to look at free cash flow unlock. So it is about strict cost management. It is about making sure that our capital programs deliver, and that's why we also indicated today on the PSA project in Mozambique. This is the biggest capital project that we have currently in Sasol after the Lake Charles investment in the US, and that project at the moment is within cost and schedule, and so we are really doing very well in that regard, and we hope to see that come online towards the end of this calendar year.
Perhaps you can give us some clarity here. You had the Industrial Gas Users Association coming out warning of a potential day zero when it comes to gas supply. And they've tied it to the announcement that you made last year, saying that you're terminating supplies from your gas fields in Mozambique from June 2026. How do you see that in terms of impact for the local industrial users? And do you believe there'll be a solution in place to mitigate that?
Yes, as you know, we started to flow gas from Mozambique in 2004, and the normal characteristic of a gas field is that it will decline over time. We have indicated that in our estimation, the decline will start in the period that we've announced to the market. So it is a decline, so the volumes that we make available will start reducing. And this is a heads up to say, how do we now replenish that volume that will be in decline? And so we welcomed the position of the DTIC that in November last year got all stakeholders together to play the role as an aggregator, because the only longer term sustainable option that we know is LNG. So LNG is available globally. We need to plan for that, to bring it in as an energy vector in South Africa, and that we can get the infrastructure and the parties well in advance gathered, so that we can be ready when this start to decline from the gas fields in Mozambique, and that we can bring in LNG gas. So the mere fact of the matter is that someone needs to secure that gas offtake, and therefore you need to put up your balance sheet to secure that LNG cost. You can't just ask for the gas to be delivered, and the sellers of gas would not require any guarantees or to secure that gas. And that's where I think the DTIC and the DMRE is really, as part of the IRP plan for gas as an energy vector, as I say, in South Africa, are busy getting all the relevant parties together so that it will enable a timeous replenishment of gas as this start to decline in 25-26 period.
You made an announcement that you're going to be reviewing your dividend policy, and I can imagine one of the questions that may have come out through that results call with your analysts is the rationale of tying it to earnings versus free cash flow.
Yes, so at the moment our policy is a 2.5 to 2.8 cover of core HEPS. Now this is indicating a higher dividend payout than we announced. And so we are very conscious of the considerable recent disparity between core headline earnings and cash flow. And as such, the board currently is reviewing our dividend policy. And it will be, and the market has indicated, a lot of analysts have started to report that they believe that we will come up with a more policy that's tied to a free cash flow metric. And so the board is taking that under consideration. We've indicated today that at full year results, we will explain much more details about our new dividend policy that will most likely be linked to a free cash flow measure. And therefore, we've signaled two things today. One is that our policy is under review. And secondly, that we are confident of the cash generating ability of the business in the second half of the year, which is normally our stronger half of the year with respect to volume and output, and therefore that also will then inform our final dividend that will be paid and we will announce in August of this year.
Given the challenges that we discussed at the beginning of the interview, how do you factor them into the financial performance going forward? Are you seeing a silver lining?
I do see that the guidance we've given with respect to the volumes in terms of the big output, in terms of Secunda operations, we will still maintain that guidance of 7 to 7.3 million tons. That is, of course, very important. That's the majority of our earnings is generated in South Africa and through our integrated value chain in South Africa. And therefore, all the things that we will be in control of will be volumes, our strict cost and capital program management. So those are the things that we will focus on. And hopefully, as we read the markets at the moment, we've seen the chemicals market at the lowest we've ever seen before, lower than the lowest. And therefore, the recovery of the chemical markets have to be factored in towards the end of the year and in the beginning of 2025. As we look at our peer group, this is the end of the destocking that we see customers are globally busy doing. And at some stage, that will then stabilize demand. And hopefully we can see recovery in volumes and margins from that point onwards.